All right. We are live. You guys all still hear me?
Loud and clear.
It's strange when I don't get to actually see you guys and I'm just looking at a picture.
Handsome group.
Totally. For sure. I'm glad Janice.
Very pretty group.
Pretty beautiful group.
You guys are so sweet.
Yeah, it's good. This is we handpicked all the people who are great in their field, but also, not bad to look at.
Hey, we're gonna open it up to our Zoom audience now.
All right. So for anyone who is joining us right now, we're going to go live in a few minutes. We are live right now, but we're going to give people a few minutes to sign on, get situated, and at about 2:35, we're going to start this. We're excited. I'll introduce myself, I guess, while we're at it here. I'm Ayal Shmilovich. For those of you who don't know me, I'm managing partner at Gerber Kawasaki. We have Scott Price and Janice from. I'll let you guys introduce yourself.
Janice, go ahead.
I'm Janice Ho from the Price and Ho Group, real estate group. We sell real estate on the West Side.
I'm Scott Price from the Price and Ho Real Estate Group, and Janice and I have been working together for about 16 years, and we sell real estate on the West Side of Los Angeles.
And I'm John Ciolino with Bank of America, and I've been doing this for about 30 years. And I do most of my business in the West Side and sometimes all across the United States. But for the most part, it's the West Los Angeles area.
Awesome. We know people are going to have a lot of questions. A lot of our clients are on the West Side, but we have clients scattered all over the city and all over the country, much like you, John. So, while some of this stuff is going to be centered around West Los Angeles, we're going to talk about some, generalizations for the rest of LA and then possibly the rest of the country as well. And while we might not have the right real estate answers for you, in the rest of the country, we're certainly going to talk about, some of the trends and kind of what's going on. So just, a couple more minutes. Thanks for everybody for joining us. Just bear with us as we are in this awkward silence moment where we're waiting for everybody to join. But I'm excited to have you guys. 4 people, everyone here is kind of an expert in their industry. I know firsthand, Price and Ho, firsthand for my clients, for myself. Great job. I've been working with John recently. Super knowledgeable, great guy. So listen to what these people have to say. They all know what they're talking about. Anything you guys want to add before we get started?
That real estate is really a micro market business market.
Mm-hmm.
So, we'll be able to share with you what's going on West Side Los Angeles, but we don't really know what's going on in different neighborhoods all across the country, unlike the financial market.
Okay.
Yeah.
Thank you.
Yeah, grateful to be here. Hopefully we can help some people get some insight on their questions, maybe some concerns about the COVID, market and what's going on out there. So we'll be able to tell you real time what we've been seeing, what our buyers have been seeing, what our sellers have been experiencing, even renters, landlords. So we can kind of delve into some of those topics as we go along.
Perfect. Yeah, and from the mortgage side, I can try to answer as many questions as possible during these times, and how it's affected the overall mortgage market. So we're here to help out.
Awesome. All right. I'm waiting to hear back from Alan saying we might have some kind of technical issues. So waiting for a second. So sorry, guys. Just bear with us. One of the beauties of the joys of the COVID world is we get to do all this technical stuff. Okay. Okay. So there is an issue. There is a slight issue with Zoom, but we are live on YouTube and Facebook. So let's just kind of get started to begin. So I want to introduce myself again real quick. Ayal Shmilovich, Managing Partner at Gerber Kawasaki. Ayal Shmilovich at Gerber Kawasaki, Managing Partner here with Scott and Janice from Price and Ho Real Estate, and John Ciolino from Bank of America. We're here to talk real estate, investing in the stock market, investing in real estate in this COVID and post-COVID world that we are in, and hopefully we'll be out of soon. So I just wanted to give you a little bit first. I'll start with the boring stuff, which are the disclaimers. For us, just make sure everything we talk about today is not a recommendation that you do. You should always contact an advisor for any investment recommendations, and everyone's situation is different. Please feel free to reach out to myself and anyone here on this call. If you have any questions, we're here to help. So with that being said, I want to talk a little bit really quickly. So obviously, the last few months has been a very unique time in all of our lives. And I sat there thinking the other day about one day when my child is old enough, I'm going to tell him about all the crazy things that happened in COVID. Even though he's living it, he probably won't remember it quite as clearly as we do. And it's definitely created many questions as to what's going to happen for investing for the near future and for the next year or two. So our firm, Gerber Kawasaki, we specialize in stock market and bond market investing. We'll talk some about that, and then we'll let the rest of us talk about the real estate market and their opinions. If you guys have questions, please feel free to shoot them over to us in the live chat. We'll get to as many as we can, and we'll have time at the end also for questions. So really, really briefly, I just want to kind of talk about where we're at right now. For those of you who have been investing either in the stock market, obviously, March and April were very challenging and kind of crazy time in the market, with extreme volatility, and that's how markets generally react in the short term when there's uncertainty, which obviously COVID has done a lot of. And then in the last couple of months, we've had a pretty big snapback in the market, which is leaving a lot of people with a lot of questions as to where do we go from here. What's going to happen in a market where we had the highest unemployment we've had since the Great Depression. We don't really know what the economy is going to look like for the foreseeable future as we just start to open. So normally speaking, in economic cycles, the stock market reacts first and hardest, and then tends to react to the upside again much quicker. So just to give you guys just sort of a comparison, in 2009, when we had the financial crisis, the stock market bottomed in March of 2009 at the pure depths of the recession. And it wasn't until a couple of years later that the market, that it wasn't until a year later that we were out of recession, quote, and real estate, which obviously had taken the hardest hit, had taken a few more years to come back. It was almost 3 years until the real estate market had fully bottomed. So we really want to kind of talk about what this means for us. History doesn't repeat itself, but it rhymes, as people like to say. So we're here to talk about some of those rhymes. And with that being said, rather than me just kind of talking at you guys, I really want to get Janice and Scott. I really want to get your guys' opinion as to what you're seeing post lockdown. Right, people are out and about. Obviously, no one was able to buy houses in lockdown, or very few. What are you two seeing now?
Yes.
Thank you. The first month of the lockdown, it was very uncertain. We actually weren't even sure how we should advise our clients because we didn't know kind of what was going to happen. California Association of Realtors was coming up with new guidelines within the first week and a half, 2 weeks of the lockdown. So it was pretty quiet the first month, I would say. We still had sellers who were preparing to list their properties that we were trying to time out when they should put their properties on the market. And then buyers, actually, I would say at the time, probably 50% of them fell out of the market, decided not to buy. Since then, about, I would say 6 weeks ago, it's been like nothing changed. It's like back to normal in terms of there was always a backlog of buyers even up until the shutdown, and then there would seem to be even more because now there's more buyers, fewer listings, so less inventory, and we're seeing a lot of multiple offers on properties and prices being driven back up again. So with that combined with the low rates, the buyers are out there, at least they are on the west side.
Yeah, I echo all of what Janice just said, and I'll add on a couple of additions there. From a Compass, a recent survey, the single-family home searches are up 40%. So what we're seeing is a lot more interest in buyers looking at single-family homes versus condos or townhouses, where they may have to get in an elevator with a group of people, or go down a hallway, or go down certain through other doors where people have touched and whatnot. So we haven't really seen the outcome of that quite yet, and we probably won't for a number of months. So that's an interesting take on it, is that will there be a shift more towards suburban single-family homes, your own four walls, so to speak, and less so towards condos? So that's the first thing. The second thing is, with regards to sellers, it's with everything that's going on with COVID, it's a little bit more of a daunting task to be a seller, because you've got to be way more flexible right now, especially with timelines with lenders, appraisals, getting the underwriter team to get things signed off, getting in and out. Just to get inside of a house right now, we have to have an 8-page form filled out and signed just to go look at the house. So anybody who enters the house has to sign this declaration, right, to get in and out of the house. You can't touch anything. You're only supposed to have 2 people in the house at a time plus an agent. So sellers have got to be flexible, and buyers, we still think it's a good time, and we're seeing that there's still a lot of multiple offers, just like Janice said. It's like maybe a little bit less competitive right now, slightly, but still, it's almost like nothing has skipped a beat since the shutdown in mid-March.
And do you think that a lot of this is just pent up because people haven't been able to look at houses for the last 3 months? Is there stuff like PPP money that there's just we won't talk about the trillions in liquidity in the market just yet from the Fed and such? But do you think that a lot of this is just sort of pent up appetite for the people who weren't able to kind of deal with this stuff right now?
So I'll jump on that one really quickly. So yes, I do think it's pent up appetite. I think that before the shutdown, there was still a ton of buyers out there looking for homes, and there was very low inventory. So yes, part of that is yes. I would say the second thing is there are some that may think that, hey, I may want to take a little bit of money out of the volatile market and put it into real estate. Right? Just because let's be honest, the market is pretty high right now, right? And it's still pretty high, even though it's up and down every day. Might take our down payment out and put it into a house where it might be a little bit more safe. It might be a little bit more stable, which who knows is the truthful answer.
Sure.
So yeah, I think between those two things, yes, I think that's. Janice, did you have anything to add to that?
No, actually, I have a question for y'all while we're talking about the real estate market. I mean, the stock market, market. Why do you think it is so hot right now? How is that? It also doesn't seem to make a lot of sense.
Yeah, I think the answer, look no further, is the same reason that the real estate market continues to be so hot is. There's a ton of liquidity in the market right now. The Fed has pumped a bunch of liquidity into the system. Interest rates are at 0, also driving the real estate market, right? And people are trying to look past what's going to come over the next 2 quarters when earnings are happening, right? So we know that Q2 is going to be a terrible earnings season. We already know that. We know that Q3 is probably going to be bad also. But people have already started to look forward as the stock market tries to predict what's going to happen 6 months from now, generally speaking. So I think everyone's kind of looking past it and hoping for this sort of V-shaped recovery. I'm not as convinced on a V-shaped recovery as a lot of people are. But that being said, just like with real estate, there's really no other. There's two games in town right now. It's the real estate market. It's the stock market, because I could buy a 10-year government bond that pays me 0.7%. For 10 years, I can lock a 0.7% interest rate. Like, who would do that? And believe it or not, we're the best market because we could go to Europe and get negative rates, or go to China and get God knows what from them. So
COVID? Sorry.
Janice.
Sorry, only I can make that joke.
And the Bank of Japan also has some negative rates, So really, it is a question of money needs to go somewhere, and if it's earning zero, we're always going to be searching for a place to dump it where we're actually going to get some kind of rate of return, and that's what the stock market is. The second thing is actually, while the market seems to be high, it's mostly driven by one or two sectors of the market. And thankfully, it happens to be the two sectors of the market that we specialize in, and me personally, but it's technology and healthcare. And I'm going to put technology and communications, the S&P technically breaks them into two, but communication being Google and Facebook and Netflix and such. But these sectors of the market were already the drivers of the market before COVID. And just like everything else, COVID kind of threw into light, right, everything that was wrong with the economy until now. And this was sort of the final nail in the coffin for those, be it real estate, not real estate, sorry about that, retail, or energy, or those kinds of things. So if you look at the big companies that everybody knows, Apple, Amazon, Microsoft, Google, Netflix, and Facebook, they're driving the market. That's what's driving this market higher. In fact, if you strip those companies out, the return is significantly lower. So it becomes very important to invest in the right sectors of the economy and not just sort of indiscriminately buy everything. Much like I would imagine you two would tell me, right? If I buy a house, some random house in LA, it's probably not going to be the same as if I buy, north of Montana in Santa Monica. That's like what I call the Apple real estate over there. And so that's kind of how I imagine you guys feel about real estate right now, because it's super hot also and super high, right? Yeah. So that's my take. That's our take. I do think we're going to experience some more volatility over the next few months as we sort of see this permeate through the system. And I'm curious to see what happens once the sort of reality sets in versus the optimism, right? Record cases again spike in Texas and Florida. Hopefully we're not going into lockdown again. But what happens is all this trickles down through the system into the real economy. And how does it affect real estate? How does it affect the stock market, right? In general, real estate is a longer process to feel the effects, right? Because somebody needs to lose their job first, then they have to go. Now we have mortgage forbearance for 12 months since COVID started. And then we have things like, foreclosures and all kinds of things that will have to trickle through the system, and then we'll see. So does the mortgage forbearance, does the liquidity, does it prop us up long enough to keep us afloat? Or does it simply elongate the cycle into, okay, we kick the can down the road 6 or 12 months, and now we're going to feel the real effects of the economy?
So right now we're still optimistic. At least the stock market, or that sector, a couple of sectors in that stock market, and also I guess you could say in real estate as well.
Sure.
Optimistic, and also future planning. So planning for long term, not just looking for the next 6 months to 1 year even.
Exactly. Yeah. Just like you guys, the stock market, because it trades on a day-to-day, second-to-second basis, we have this, proclivity for saying, oh, the stock market is risky. the stock market is, it's super volatile, it's crazy, I don't want to deal with it. Real estate is a safe bet, only because it doesn't price on a second-to-second basis like the stock market does, right? So just like you guys, when I give the analogy to a lot of my clients as your investment portfolio is like real estate, right? You have ownership in companies. It's like you're owning the property, and they can appreciate, and then you get dividend income, which is just like rental income, right? So they're just kind of two sides of the same coin, and both should be used as long-term investments, right? Janice, someone today asked you, I want to buy a house and flip it in 6 months. What are the odds that I'm going to make money? I don't know. What would you tell them?
It's much more uncertain, right? Yeah, right. Yeah, risk is higher.
Correct. Exactly. You could make money just like you could, but ultimately we all agree, right, that investing is a long-term thing.
Definitely. What's going to be interesting, Ayal, is going to be what's the new normal, right? What's the new normal with restaurants? What's the new normal with gyms? Are all these, movie theaters, bars, sporting events? What's that going to look like? And all the people that have jobs within those sectors.
Yeah.
Right. Yeah. And this whole work from home thing in this, how is that going to impact people wanting to buy and stay in their homes? And, how is that going to impact it? Because that really wasn't part of the conversation back in 2008, 9, 10, 11 during the recession when those things were happening. So this is a really interesting, different time here. And I don't think anyone has a real clear answer.
Yeah. And I'm curious to get your point of view on this, guys, right? So we have a few cross currents working, right? So commercial real estate, in some senses, a lot of it is going to be challenged, right? You have 24-hour fitness going bankrupt. AMC is on the verge of bankruptcy. So all these sort of, mall retailers, all this kind of stuff is going to be challenged. On the other hand, you have things like, distribution centers or logistics, which are thriving thanks to, the digitization of the whole world right now, and Amazon fulfillment or Shopify or all these companies, right? And then I'm curious as to your thoughts on the residential side as to market, like let's say, let's focus on LA because it's a city, but it's not sort of the traditional city that most real estate is like New York or San Francisco. Do we see more appreciation in the underdeveloped areas because now work from home is more common, or do we see real estate rising across the board because now a home is more important essentially than an office is?
I'll jump on that one very quickly. I just read an article this morning that talked about, okay, so I'm going to work from home. Well, why do I need to live in LA? Or why do I need to live in New York? Or why do I need to live in Chicago? It doesn't matter where I'm talking about. I could live out and have a beautiful, huge, massive property in the middle of Utah somewhere, and I can work from home and do my thing and whatever. So that remains to be seen, whether people are actually going to jump from LA and all of the, I may call them trappings of LA, the beach, the weather, the lifestyle, and, whatever you want to call it. And are they going to actually jump ship and go out to the middle of Utah and buy, $100,000 property with 50 acres?
Right.
I don't know. That remains to be seen. So that's the first part about it. The other part is the work from home. So I think people are going to guard their personal and their private residence a lot more. They're going to value it a lot more. And I think if they spend money, and even if it's a year or two or three, spend a lot less money in going to Lakers games, going to see, a movie, or going to see, a $500 concert to go see, name band.
Yeah.
All of a sudden you got all this extra money and you're like, wow, babe, maybe we can actually afford, spending $500,000 on a house and getting something, where maybe they wouldn't have 6 months ago. So it's a very fluid, interesting time to see how that goes. But then you mix in to that conversation, well, how stable are our jobs? Are we, at risk of getting coronavirus? And do you have a condition that, God, what if one of us gets sick, if we're talking about a couple or a single person or whatever? So then you've got all those other things floating in there that kind of create fear factors for someone to buy. So I don't know. It's really interesting to see. John, what are you seeing? We haven't heard one word from
How's John's experience?
I was ready to ask a question for you. Just a question real quick to you guys, Janice and Scott, with and this may be too short term right now with all of this just happening, but do you see buyers now requesting the bonus rooms or the extra room for a home office? Is it too soon, or are you seeing that yet with buyers?
Janice, you want to on that?
I feel like we were seeing that before already, that people were looking for a space for either an ADU, the accessory dwelling unit, or a space that they could create a little corner wherever it is, or a home office. There's definitely, obviously, people are going to be pumping in a lot of money into home improvements, making their home their refuge. It's going to be staycation. Everybody's thinking it's going to be staycation or work from home cation
Right.
for the foreseeable future. So even contractors are very busy that we speak to. Interior designers are incredibly busy. Gardeners, everyone wants to make their home their refuge. Right.
I agree with that. I think, John, to answer your question, from what I've been seeing, is that people are wanting to buy something nicer, something a little bit further out of reach. It's because if you've got to be home all day, at least it's going to be a little bit nicer and a little bit more pleasurable versus sort of like, just kind of getting in there, just the regular old place, I guess.
Right.
Condo or house.
And anecdotally, I've heard some stories about places like formerly, just not the best tourist destinations, but places that are sort of close by that people can travel to via car, vacation homes becoming much more prevalent now. So somebody I spoke to recently saying they, in the desert in India or La Quinta, where everyone used to buy for Coachella and things like that. Obviously, that's not coming, but because it's now a staycation spot, that the offers on homes that are off the charts because people want an escape.
Mm-hmm. Yeah, very true.
Yeah. So, and again, all of this, if we get a vaccine in a year or 6 months or whatever, we might be having a very different conversation, obviously.
Right.
And John, I'm curious also. So, this morning I got up and I read, we had some records in mortgage applications, things like that. Home buyer demand at an 11-year high, 11 or 21% from the year before. What are you seeing on your end? Rates as low as they've been, 3.3% is the national average now. With a lot of people I know getting sub-3 loans. What do you guys?
Exactly. It's amazing. It is. Interest rates are very low, so that's obviously helping with the demand. I think going through the shutdown for a while, we had a lot of sellers obviously that weren't putting their properties on the market, and all these buyers, they were still there. A lot of these buyers were still there. So I think the demand in the mortgage business right now is because there's when I think of interest rates as historically, when I've been doing this for 30 years, we're seeing 30-year fixed rates in my 30 years at the lowest levels we've seen them in a long time. So where rents are so expensive, especially in our marketplace in Los Angeles, it's very, very expensive to rent a place. So looking at these mortgages, they're very attractive right now to purchase. But that being said, though, what's happened also with the mortgage business in general, there has been some pullback. When you look at across the board with most lenders nowadays, some of the key factors that you're going to be looking at, larger down payment requirements. Most lenders have pulled back. If a lender was doing 20% down, they may now require 25% down. FICO scores, you had credit scores that prior to COVID-19, you can have very low credit scores with a lot of lenders. Almost every lender has increased credit score requirements, cash reserve requirements. The one thing I'd say that it's been nice with the lenders, they kind of stepped up to the plate with the appraisal piece, because most lenders are okay with drive-by appraisals. Because we started seeing, especially at the beginning of this whole thing, we saw a lot of issues with, it could have been a seller, it could have been an appraiser. I had one situation where the actual appraiser is the one that refused to go out to the property, didn't want to go into the property. Yeah. So the drive-by appraisals have been a nice piece. But that's also an issue with some lenders where the drive-by appraisal may not be enough to consider an exception or to do a cash out refinance. They may want to see the inside. So you've seen some of these guideline changes with these lenders just because the appraisal piece has been kind of put on hold to get that full appraisal with the interior photos.
And I also read that over 60% of the applications for mortgages are refis. Are you seeing like more refinances than first home purchases?
A lot of refinance. With rates as low as they are, the refinance those have been exploded. So we're seeing a lot of that right now. Yeah.
And everything you just said, John, makes me think of, unfortunately, one of the other things we're dealing with in this country, which is a huge issue, is income inequality, income disparity, right? And all of these things, as much as I love being an investor in all these kinds of things, these things sort of just further the wealth gap, right? You have people who have mortgages who are refinancing. You got to have a higher credit score. You got to have a higher down payment. You got to be even more qualified to buy a home. So, average Jane, average Joe don't get the full effect of this sort of low rate environment. It's really the haves continue to have and the have-nots continue to have less, unfortunately. And hopefully we can get into a situation where, where that can come down somewhat. But that's, this sort of, free money, this cheap free money that we're getting from the Fed and from all these kinds of things is unfortunately has its downsides also, making things unaffordable, whether it be real estate or the stock market. I'm curious also now, as we talk about that, what you, Janice and Scott, what do you guys think as far as, everyone now is talking about disruption, right? Disrupting industries. Technology is starting to rule our lives now, and anyone who's not disrupting is falling by the wayside. So, number one, what are you guys doing to sort of amplify the experience with technology? And two, what are you guys seeing as far as, the Zillows and the Redfins of the world? Are they hurting your business? Are they helping your business? Or are they just kind of just there?
Janice, you want to jump on that?
Yeah, actually. So with technology, Compass, our broker, has really tried to harness more of the technology side, whether it's trying to create a platform to make it easier to communicate with buyers or to create more leads. When it comes down to working just with our clients one-on-one, it's a people business. So, we use technology to kind of keep all of our workflow, all the checklists and everything in order. But other than that, it's not selling homes. It's not a very technological business in that sense.
The only thing I could think of that has really been the game changer from when I bought my first house in 2010 to now, where I had to physically sign each paper, which was a nightmare.
Yeah. So there's some things that make it easier, right? But it's more the admin part of it. So DocuSign. Do you have anything to add to that, Scott?
Yeah, I mean, I think that with all of the websites that you mentioned, Zillow, Redfin, Trulia, I mean, I think what this is doing is making our jobs better because it's actually making us compete. It's making us be more knowledgeable. It's making the agents, it's really thinning the agents out. The ones who are really good, who are qualified and competent and really know what they're doing and really work hard for their clients, it's separating the pack. So that's really helpful for us because I'm sure in your trades, when you work with someone who, is, maybe difficult to work with, they don't know what they're doing, it makes your job a lot harder. So, but it also keeps us on our toes. So like Janice said, it requires our service level and our knowledge level to go way up. And it requires us to be really on top of it for our clients. One of the things that we're on is Yelp. And so one of the metrics that Yelp keeps is how fast we respond to inquiries. So even if we get an inquiry at 5:30 in the morning, and we don't respond until 6:30, that's an hour time length that we have not responded to them. And so it'll track and it'll say, well, and it'll publish this right on the page. Janice and Scott don't respond for an hour, or something like that. So, and then 3 other realtors, it's like, Joe X realtor responds in 10 minutes. So, it's things like that where it really keeps us on our toes, but for a good reason, I think. But it also really helps that I think it also creates confusion because our clients always come to us. I would say almost always, I can't say always, and say, oh, hey, guys, Redfin said our house is worth this much. What do you guys think? And then we tell them, we go through and we go through the comps and we say, well, I don't think Redfin actually went into that house down the street from you guys and saw the interior. Well, Janice and I did. And so here's the biggest difference is these X, Y, Z, all these things. So we think your house is worth more or less or whatever. Yeah. So it's not quite there where we're going to be replaced or like that they're making our lives harder. They're actually making for the consumer, actually, they're making the experience better for the consumer. Yeah. When you're the great agent.
Got it. Yeah, that makes sense. I always like to tell my clients and anyone I talk to is, we love to incorporate technology into our practice and we use it wherever to enhance the experience, but never to replace the human element. Mm-hmm. This is something that I believe, and I've worked with you guys before, and I understand, just like with anything, right? You have people who are very good at their jobs like you guys, and you have people who are average, and you have people who are below average, right? So you always want to seek somebody who's obviously very knowledgeable, knows how to deal with technology, knows how to enhance the experience. Mm-hmm. But also, buying a house is much like investing in the stock market. There's certain things that people feel like they can do just because it's available to do it, but they probably shouldn't. Like, you probably shouldn't be going through John's mortgage applications by yourself because you'll probably get a migraine just looking at it. It's not curated.
An application only is that simple. It's what's behind the application.
One part. I'm just saying, just that part.
Just that part.
You'll get a migraine just looking at it, and then on the flip side, you go see a house. If you're going to spend a ton of money on a house, it's the biggest purchase you're ever going to make. Are you really going to do it through an app? Probably not. So you need people who are knowledgeable, who are good, and who are going to work for you. And that's ultimately what technology has shown us, right? Is that the people who adapt and utilize it well and still provide that concierge level service are going to be the ones that flourish.
Mm-hmm. Right. Mm-hmm. Right.
So I'm interested in was interested in your guys' perspective from an investment point, because we've been kicking around the Zillow and the Redfins for a while. Also, we do invest in real estate. I'm a stock market guy, as you guys know. I am looking to buy my home, also, but I invest in real estate through the stock market, and a lot of people are not well versed in that. But you can buy real estate trusts in the public markets. So we invest in companies that are, whether it's, REITs like Blackstone, which is the largest owner of residential real estate in the country, or MGM Properties, which is casinos in Vegas, or 5G cell phone towers, or cannabis logistics. So there's investment processes all throughout the stock market also. And to me, I like real estate. I'm just not going to be the guy who who buys a building and has somebody and manages the property on my own, because that's just not my skill set. But I think it's important for people to know that they can own real estate on their own. They can, they could be their primary home. It could be a vacation or something they rent out, or you can own it on the public markets also, with some valuable ads there, liquidity, and then having people who know what they're doing, obviously, kind of manage your money. So, I'm curious if you guys interacted with any of these like a Blackstone? Do you guys ever come up against them and when or do they just buy an insane amounts of properties that sort of they don't compete in the same space?
Janice, do you want to?
I don't think we've ever had to compete against an investor like that. Okay. Yeah, I don't think that. I'm not sure that they're buying in this mark or in territory. Mm-hmm. Yeah, if they're buying in bulk, especially.
Yeah.
So there's no competition with it's maybe the hardest competition is the cash buyers, and there's cash buyers, whether it's from a foreign national or even local. Yeah, would be the biggest competition, but no.
Are you guys seeing a lot of cash buyers now?
We still are.
Yeah.
Mm-hmm.
Yeah.
And what do you think the reasoning for that is? You know, given just the insanely low interest rates, why are people still eager to shell out a bunch of cash to own a property?
I think because the first thing is probably because they feel it's the safest bet. I mean, that's probably because if I took $1 million, put it in the property, all right, I don't have to pay the mortgage. I don't have to go through the loan. I may not even be qualified to go through the loan process because maybe I don't have a job or my job, whatever. But then they might be scared to put it in the markets. I mean, that might be the case. So they just sink it into real estate, and then that they don't have to pay the mortgage, they don't have to pay the interest, and that's how they feel safe.
Now, and I do see a lot of clients come, after purchasing property all cash, they come back to a lender and say, could I recoup my funds? So you see that too, because it's so competitive. You'll have a client that either has the money or has a family member that has the cash. Yeah. So you know what, pay cash for the property, just get a loan afterwards. So you do see that, and that's what we call delayed financing.
Okay.
In the mortgage business, where you can obtain it afterwards.
That's interesting.
How do the rates look for that compared to purchase?
It's a good question, Janice. It depends. Lender to lender, it's different. Generally speaking, though, that the lenders that do what we call delayed purchase or delayed financing, the rates are similar to the purchase money rates. So they're not going to be they're not going to be identical. They're going to be a little bit higher, but pretty close. They won't be as high as a refinance rate. So a purchase rate may be anywhere from 1/4 to 0.5% lower than a refinance rate, where a delayed purchase may only be 1/8% difference. So it's still very competitive, and that's why it's still compelling to a lot of clients to pay cash if it's going to get them the house to get a loan afterwards.
So,
and I was just going to say, a lot of people are using it as a strategy in multiple offers to pay the all cash to win the bid, because typically sellers like to have cash over lenders because there's so many hoops and ladders you got to go through with the lenders.
So two questions on that real quick, and then we'll wrap it up real quick and take some questions. But two questions on that. One is, are you seeing, like, is there a market difference if somebody comes in, let's say let's just use $1 million for an easy number. Property is $1 million, and somebody comes in with 25% down, and somebody comes in with an all cash offer. Like, what percentage of the time are they going to, assuming that the guy with 25% or the girl with 25% is a highly qualified buyer, what percentage of the time are they taking the cash offer if it's even slightly lower?
I don't think we have any percentages to work with because honestly, everything is so situational. It's all case by case. So it depends on what the seller situation is. Sometimes the seller doesn't even need to move quickly, so they don't care if the all cash offer is going to close fast. So it really is case by case, but it takes, when there's a cash buyer, it takes out the uncertainty of a loan and appraisal contingency, really. So it just is a more sure thing in some ways, but not all sellers go for the cash. Just because the cash offer comes in doesn't mean that they'll win, because ultimately most sellers are looking for the highest.
Yeah, that's what I figured.
Yeah.
But the best chances to close too, in the story, and it depends on how emotional the seller is. So sometimes sellers are super prideful of their homes, and they want to see the letter. Are they going to tear it down? Are they going to keep it? What are they going to do with my beautiful home, right? And so it really depends on a lot of those factors. Like Janice said, it's very case by case. And we've seen the clients that have a loan win over the cash buyers and vice versa. But I would say, if you were to put it on an average through the span of our careers, if everything is equal, more often than not, a seller would opt and lean more towards a cash offer.
Okay, and then the last question I have for you guys is.
Wait, guys, sorry. Thank you for having me, Ayal. I am at a geotechnical inspection upstairs in the bedroom, so I have to leave because the inspector's ready for me. So,
thank you, Janice.
And yeah,
Hi, Janice.
all right.
Hi. So last question for you guys real quick, and then we'll take the questions is Scott, if you're representing the buyer, or John, if you're seeing the application, and somebody wants to put 50 or 100% of the price in cash, do you ever recommend that maybe they don't do that unless it's a highly competitive situation? Because to me, if I can get a sub 3% mortgage rate, that's free. That's kind of like having money for free almost.
Mm-hmm.
Why would we lock up this much money in an illiquid asset when funding is so cheap and you can do other things with that? Obviously, you're scared of the market, et cetera. But do you ever recommend to say, listen, you don't really need to put 80% down?
John?
I'll start by saying, and Scott, you could probably confirm this, but there are a lot of situations where a buyer does go into it wanting financing, but has the cash to pay all cash, and they'll write the offer all cash with the clause to say they reserve the right to get a mortgage, but they don't put it in as a contingency. So that's a very powerful tool as well.
Okay.
But yes, usually if a client comes to me, well, I'll have that. I consult with every client. So if a client comes to me and says, I'm putting 50% down, I'll speak with them and go through their finances. And a lot of times it's what they want. It doesn't matter. It could be just, this is the mortgage payment we want.
Yeah.
We as lenders look at someone and say, okay, we can go up to, let's say, 43% debt load. 43% of your income is a debt load. But some buyers or some people only want 20%. Doesn't matter if a lender is going to qualify me for a larger loan. So, but I do walk through that and discuss different loan options, because sometimes they come in saying, I want a 30-year fix. That's all I want. And then when I ask the question, they say, I'm actually only looking to buy this property and stay there maybe 5 or 7 years.
Right.
And if I bring up a 7-year ARM or a different product, then they say, you know what? Maybe I can get a little bit more financing.
Yeah.
Yeah.
And that's what I think. Sorry, go ahead, Scott.
Yeah, I was just going to say, I almost never advise the clients on what they should put down or not. I say to talk to Ayal, and I say to talk to John. I mean, it's really not my place. I'm not a financial advisor. I work with real estate, and I'll talk to them the value of the home, what I think they should offer, and then get in there and request repairs, help them make the best choice there. But I mean, seriously, like they bring it up to me. I might ask them some strategic questions like, well, I mean, are you going to be uncomfortable with the payment? Or like, I mean, I don't know how much they've got in savings. Like, I don't really know where their financial position is. So,
and that's a great, thanks for that. That's a great sort of insight. And I think all of this, whether you're buying a house, whether you're investing, mortgage, I think the important thing here is to have a good team around you. That's what the whole idea is about, guys. And for all those listening is, you need to have a financial advisor. You need to have a real estate broker that knows what they're doing. You need to have a lender that knows what they're doing. And you need to have people in your corner that actually are going to ask the right questions and make sure the right things for you are happening. With that being said, I want to take some of the questions here that a lot of them are in private, so I haven't seen them, unfortunately, because I was on the live comments. But we have, let's see, a lot of buying activities due to pent-up demand from before the pandemic.
These were some notes, Ayal. Those are some notes from earlier. I think the notes actually start, the questions start from, are we good to go live? And then from there on down.
Okay. Yeah. So that's the one I have here. I have, okay. As the pandemic drags on, pent-up appetite dissipates, people tend to hold back on luxury large item purchases, including cars and houses. Do you think that's going to happen? I think we kind of touched on that. All of that really remains to be seen, depending on in my opinion, how the recovery takes shape over the next 6 to 12 months. I do think we have a fundamental reworking of our economy happening, and maybe not 100% and not a doomsday scenario like everyone's saying, but there is going to be like live events. It's going to be a long time before we have a bunch of people, 100,000 people going to Coachella. Until we have a vaccine, most likely. So I think it remains to be seen. Like anything, it's hard to tell what's going to happen in the next 6 to 12 months. But I like to tell people, if you're going to invest in a big ticket item, whether it be a retirement account or a home, it's a 5-year time horizon. If you're not going to hold an investment for 5 years, it's not really an investment. It's really speculation. I don't know if you guys have anything else to add on to it.
I'll jump in with that. I mean, it's from Mr. Patrick Poon here. It's really tough to say, but what I will say is that, listen, if you're trying to time the market in real estate, I mean, good luck. I mean, that's a really tough one. I mean, some people have gotten lucky with it, and some people may claim to like know exactly what's going to happen, but be very, very careful with that.
Yeah.
If you are, I think if you are paying rent, and this is to the renters out there, if you're paying a really high amount in rent right now, and if you're thinking that it might take 3 or 4 years to have the market come down, let's just say you're paying $50,000 a year total in rent, and your mortgage could be $50,000 a year. Remember, your monthly payment, no matter where it's going to go, it's either going to go to your landlord and their banker, or it's going to go to you and your banker, right? Or to the bank, I should say. So think about it like that, and don't think like you're going to go in making a bunch of money on your house. You got to think about it long term, like you said, Ayal. And what we always tell our clients is have a plan B. If you're forced to move, if something happens, like someone gets sick or anything like that, talk to your realtor about how much can you rent it out for, so you're not in a state where you have to panic sell. That's what we always want to avoid with our clients is having a situation where they have to sell. So even if you're off by $500 or $1,000 a month for 3 or 4 years, maybe that's not so bad, because look what happened after the Great Recession. It's like within 2 or 3 years, everything came back.
Yeah.
So anyway, those are things that we could always talk about on individual basis, but
Sure.
yeah. But there are some cases, Ayal, we talk about this too, where if you're rent controlled and you've got a great deal, maybe it's better to do the Blackstone, or if you're buying a primary residence, maybe buy a duplex a little further out somewhere where you can afford it and get that one started and continue to do Blackstone. And I think the key is both.
Yeah.
Equities and real estate.
Oh.
Another rule of thumb when it comes to financing is rates are very low right now. They may go up. So when you look at purchasing something today, this is kind of a rule of thumb. For an increase in interest rate of 1%, it's usually about a 15 to 17% difference in purchasing power. So to keep that simple, if you're buying something today at $2 million with current rates, if rates go up by 1%, you may be looking at something for, what am I in my head, $1.7 million, in that range, $1.75 million. So you may say, I think prices are going to drop, but if they drop and rates go up, you're going to be kind of at the same level as far as mortgage payments. So that's something to keep in mind. I'm not saying it's going to happen, but it's something to keep in mind.
You got to work on your down payment. That's the big hurdle, right?
The down payment.
Exactly.
And the closing costs and furnishing and all of that. All right, so let's see. This one's good for you, John. What do you think it will take for lenders to loosen their loan requirements, i.e. lower down payments without PMI and lower cash reserves?
Well, the PMI is always, the easy part is the PMI. The PMI is usually going to be there if someone's putting less than 20% down.
Right.
So that's, I've been doing this for 30 years. PMI is always there. So if you put 20% down, no PMI, and there are some lenders out there that do less than 20% down with no PMI. So there are some exceptions.
Mm-hmm.
As far as the lenders loosening up, like I mentioned earlier, there's tightening right now with what's going on with COVID-19. I think we have to kind of just wait and see how it all unfolds. What really is the result of the mortgage forbearances, the true, unemployment numbers, and all this that we've seen. How is it really going to affect the market? So I think lenders are going to stay in a cautionary pause right now, but at the same time, they're still lending. So I think they feel safe in our marketplace, the West Los Angeles marketplace, because there's still very competitive financing available and low down payment still available.
Yeah.
So.
All right. Let's see. What online resources do you recommend for due diligence around valuation, area demographics, etc., whether it's for purchase in LA or elsewhere?
I mean, Zillow, Redfin, they're both great. I mean, I would say that they're will give you a good idea, but it's not going to be what is super specific. Okay, but that's going to give you an idea. You can go in there. They're very rich with detail. Compass is also a great place to look for some information like that. So Compass, Zillow, Trulia, Redfin, all great.
Yeah, that's the ones I use.
Yeah.
And then we got one last question here. As we head into elections, it looks like Silicon Valley is headed towards a showdown with GOP. How will this affect the tech sector? It remains to be seen. I think there's going to be a lot of saber rattling from Washington, specifically from the president. Now he's in it with Twitter. about, technology sectors. And, every day we hear about antitrust stuff with Amazon and Apple and Google. And so there is a regulatory risk there. Ultimately, a lot of this stuff is usually just saber rattling, and we have a president that does it very well. So I think there's going to be a lot of talk about it. And ultimately, I think just like anything else, we're going to move on. But at some point, there is going to be something that has to happen with big tech. These 5 companies control more market cap now than almost every stock market in the rest of the world. So those 5 companies are now bigger than every other market other than one, and they might have even passed them now, which is Japan's stock market. Bigger than their so we gotta have to wait and see how this all comes to pass. But I don't think there's going to be any major issues. I think that people, Facebook and Google and Amazon are the most susceptible. I think Apple and Microsoft are less susceptible. But that being said, who knows what's going to come of this? Most of the political season is all about theatrics. We know what follows is generally less real. But I am curious to see how real estate gets affected in places like San Francisco if more Silicon Valley people are now working remotely. We saw Facebook offer to sort of have people work from wherever, but they'll pay them commensurate with wherever they're living. So I wonder what that effect is going to have on a specific market like New York and San Francisco, both who are very concentrated, but also, concentrated as far as population, but San Francisco, which is concentrated in tech and has the most flexibility to go remote, and how that works out. So I think that's all the questions that we have. I want to, hang on one second. Yeah, so follow up. What resources might level down from that? I use Redfin regularly, but want trend data and stuff that may be less salient. As far as real estate prices, there is something that we use a lot to look at, real estate over time and what it looks like. It's called the Case-Shiller Index. Robert Shiller is a very famous economist, won the Nobel Prize and such, and has tracked real estate over, the country and several key cities over time, and it kind of gives you a good idea of that if you want to look for that. So with that being said, I want to wrap things up. I want to thank everybody for joining us. Scott and John and Janice, who had to jump off. Thank you guys so much for your insight. I know that this is, this is something that everybody cares about. Everybody thinks about real estate. What I want to stress to everyone here is, if you have questions, please reach out to us. For those of you who are our clients at Gerber Kawasaki, we're here to help you build this plan to get into these homes. We have resources like these two here to help you buy the house, to help you figure out, financing options. What are the best areas? Like Scott says, stocks are like houses. Each one's different. You can have 2 houses in the same block, but one's Apple and one's not. And so it's very important to have people guiding you. And so if you take anything away from today, don't try to do this all on your own. Get help, and we're all here to help you with anything you need. Anything you guys want to add?
Yeah, I'll just jump in. I mean, I really feel the same way that what you just said, Ayal. This is about providing great information, experienced information where we can talk about our past clients, what's really going on in the market. Look, there's no realtor in the world that's going to force a sale on anybody. So it's really going to come down to, if you're ready, we'll provide you with the best information so you can make the best decision. The best team around you. We've got resources like John, who's been an awesome, incredible resource. That guy right there alone, 30 years in the business. I can call him and talk to him about a situation, and he'll come up with a great answer for me to talk to my clients about, or I'll just send my clients over to John. Same with you, Ayal. It may not be the right time, or it may not be the right situation for a buyer to buy or a seller to sell. So that's when I might put them in touch with you so they can talk about their options, like, okay, should we rent it out, and what are the differences if we invest? So it's about providing quality information not having like a desperate need to make a sale one way or the other. It's just about building the relationship. And a lot of times we'll say, no, maybe you're not ready. Maybe this isn't the best fit for you. So, yeah.
Awesome.
The one thing I want to add is in regards to just discussing, mortgages with the lender, some people feel like they have to wait until they're ready to buy. At least they think in their mind they're ready to buy. Even if you are a year, even 2 years out, it's not a bad idea to start speaking with the lender, because a lot of times we can help with a blueprint where we can say, you know what, I can see here's your finances. You're not in a position, that you're not in a position to purchase today, but here are the things you can do, whether it's helping with getting the credit improved or saving towards a down payment. But don't hesitate to reach out just because you're not ready to buy. We're here to help. We're here to answer any questions we can.
That's
Such
awesome.
a good point. Such a good, and Ayal, I bet you would do the same thing, even if you're not ready to invest. At least you would take some time to talk to somebody about, like, okay, so here's the things that we'll talk about when you're ready, and getting you guys set up on.
Absolutely. I talk to people like that all the time. It never hurts to consult. People on this call are not going to charge you for a consultation, especially if they were sent by one of the other people. So again, we have all the resources. We have all the tools. We always say, like you did, John, let's put the plan together. Let's put the blueprint. Let's put you in touch with who you need to be in touch with. And when the time's right, boom, we'll strike while an iron's hot.
Mm-hmm.
Yeah.
Awesome. Well, thank you so much, gentlemen. Thank you to Janice as well. And this was great, guys. And we look forward to maybe doing some more in the future.
Okay, great. Thanks, Ayal.
Thank you, Ayal. Thank you, John.
Bye, Scott.
See ya.